Hi, everyone, and welcome to Macro and Global Liquidity Analysis Gold, Silver, and Bitcoin monthly update for October 2024. We're putting this presentation together for our value clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. As per usual, we have our panel with us this evening, Joe and Paul. How are you this evening, gentlemen?
Very good, thanks, mate.
Yeah, good. Thanks, Chris. It feels like it's been a while.
It actually has been a bit longer this time because it's a long month in October, but also it feels long because a lot has been going on in the spaces that we've been following. It's been a monster month for gold and silver, which we'll get into shortly. Paul, you've got a lot to say about that. A lot happening in Bitcoin as well. And we're days away from a major US presidential election. So you really, really can't ask for much more than what's going on at the moment in the markets, can you?
Absolutely not.
Exciting ride.
Exciting ride indeed. Lots for us to dig into. Before we do, just a reminder that everything we say in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Okay, we've got our agenda as per usual here, following the big picture macro stuff, looking at the liquidity cycle as the driver of that macro cycle, having a bit of a look to see if everything supports where we think we are in these cycles, and then ultimately further going down the track of where we should be allocated or how we should be allocated in Bitcoin, gold, and silver. So starting off with that big picture, where we are in the global macro cycle, we've updated again this chart for the month. It's the one that we've been following all year, really, looking at these dots as they've unfolded. We've seen very recently a new higher green dot here, which was what we were kind of expecting. We've had a bit of a glimpse into next month's update of this, the data that shows this is actually going to be turning back blue again. Not quite sure where the dot will be, but a little bit of blue in there. That's very interesting. Joe, talk us through what's going on here and what that could mean when we see that blue dot next month.
Oh, well, first of all, we've been waiting for that higher green dot for quite a while, or what feels like for quite a while. Speaking of a blue dot, that effectively puts us back into an early cycle. So that's actually not necessarily a bad thing based on what early cycle generally means. And early cycle, which you generally see coming out of bust, not switching between mid and early, is the conditions like the ideal conditions for risk assets. So all that's really telling us is if we end up going back into early cycle is that it really is back into a risk on environment.
And Paul, do you think, like, it is a bit unusual to see that happen? Is this an anomaly because we really are still coming out of, I mean, I hate to keep saying because of the COVID era, but is it just the extraordinary nature of that period of time that you've got to expect things are going to be a little bit abnormal after that?
Yeah, you've got to remember, base effects when it comes to inflation. So that COVID inflation spike, elevator up, elevator down when you have that kind of magnitude. So that second derivative comes into play. And so whilst we're seeing inflation, continue to settle, that gets us into that early cycle where you have growth, but still low inflation. You start to see that rising inflation in the mid-cycle. So it's not a surprise at all, I don't think, in terms of what we're seeing. It's the early stages of the narrative around actually starting to see inflation grow that I think will get us back into green, and probably explain a bit of what we're going to talk about with bond markets and whatnot as well.
So I think if we dig into some of the specifics, as we will in a second, on that growth and inflation data, I think that will make a lot more sense. But I'm very interested to see where that dot ends up in the next update of that chart. Digging into the liquidity cycle, of course, we believe and we believe we can prove that the global liquidity cycle ultimately drives that broader macro cycle. We've got our long-term chart here, which has been quite popular. People can look at that online and see all of these different examples throughout history of where the peaks have occurred, where the troughs have occurred, and obviously where we're heading at the moment in terms of back up into probably that growth of liquidity phase, all the background information there. Looking at this latest update of the real-time sort of index, I suppose, is how we look at it. This long drawn out bottom that we are seeing starting to move up a little bit. It's just been choppy. That is probably consistent with what Paul was just saying, isn't it, Joe?
Yeah, 100%. And when you're looking at global liquidity as an entire global metric, the big players really are, as we've spoken about, are the US and China. We know that China at the moment are a little bit on and off in terms of liquidity, liquidity injections. Seasonality suggests that they probably should be a little bit more gung-ho with liquidity, but that doesn't mean that tomorrow morning we wake up and liquidity isn't a lot higher, or they haven't started something more significant. In terms of the US as well, same thing, seasonality, just post-election, pre-debt ceiling. We expect there's about $700-800 billion hitting the TGA at the moment. That has to be spent down before the debt ceiling. So that flowing into the economy, not the whole lot would be spent, but a good portion, 70 or 80% of that would be needs to be spent into the economy, which is why we expect that to continue higher over the next couple of months into the end of the year and into January.
So we really could see a catch up quite quickly. I mean, we've said that for a few months now, but it seems to be laying the groundwork for that. I've got a few little concerns, and we can talk about that on this next slide here. That looks at the components of global liquidity, sort of talking about the central bank money being such a small part, the collateral pool and global liquidity. Sort of when you add that all together, it's very hard to see there, but dipping towards the end here, it's like we're going back into one of those little air pocket situations. Do you think, Paul, from your perspective, that probably has a lot to do with what Joe was just saying? China has been a bit slow to the party here, and the US has not necessarily been overly proactive in injecting liquidity into the market, at least yet. Maybe we see that change after the election.
Yeah, we've had double headwinds of that. In hindsight, fairly weak Chinese response, or weak in effect anyway. Chinese response in terms of trying to get their economy going, and then the US dollar, it keeps strengthening against all odds. So it's looking fairly overbought, and I guess that fear of some early stages of coming inflation is playing in the bond market, which is reducing that multiplier effect as well. So that's a healthy multiplier is about 1.6, and we're down to about 1.5. So it's so there's a number of headwinds at the moment, but to be intellectually honest, we were talking a while ago about that TGA emptying out in the lead up to the election, because usually you see a whole lot of expensive promises and vote buying actions. We haven't seen that so much this time. So that TGA is quite high. It's sort of 800 billion, I think Joey just said. So, but what we know is coming, and is more definitive, is that debt ceiling, where they just have to have the TGA back down into sort of the 200. So we know for a fact that there's circa 600 billion that's going to come into the market out of the TGA. So there's a number of signs that this is going to turn, but it's certainly got dual headwinds at the moment.
And I think that's interesting to say that, being intellectually honest on it, because it hasn't changed. What we were saying is still true. It's just taking longer than we would have expected, because we would have expected them to load up and load up the bazooka and spend that money, as you said, coming into the election. And it just didn't happen that way. It's not that they weren't spending money, but they weren't sort of really draining that down rapidly. Yeah. But we know that they will have to. So it's certainly still on the cards. When you look globally, and this chart is the heat map that we always like to come back to, sort of showing where we are around the world. The world itself, when you look at it in aggregate, is certainly heading back into the green, is stimulating, is adding liquidity. It's just only those big holdouts that are holding everyone else back. Joe, do you have any further comment on that perspective?
I just think we're heading in the right direction. It does take time for these things to play out. Like, that picture says 1,000 words. So, we're probably going to move into a period of time, at least the next 12 months, where it's going to be either a quite dark shade of green, where central banks are easing, or a lighter shade of green with very minimal red, I imagine. So,
yeah, I think we're seeing enough evidence that the environment for the ECB and UK and a lot of what's driving this bond issue is everyone was gung ho, another 50 basis points, and now they're sort of peeling back a bit, but the Fed won't drop as much. But it's not all about the Fed, and we're seeing other central banks around the world clearly about to cut. So I think to Joey's point, we're going to see a bit more green.
I think Canada just did, or they're about to do 50,
Yeah,
50 basis points. Yeah. So for someone,
Yeah.
for an economy which is very similar to Australia, 12 months ago, which were, as tight as they were, to all of a sudden do a complete backflip. And, we haven't seen those rate cuts yet, but that doesn't mean they're not happening everywhere else, that's for sure.
Yep.
And that makes a lot of sense, particularly thinking through the fact that the world is such a large place and it's not just the US and China, that everyone else is really heading in that direction. And that chart made it quite obvious. But if we turn our attention to the US very specifically, I thought this was fascinating this month. Joe, I know you had some perspectives on this, particularly looking at the services aspect of it, because we were, remembering back to last month, we were underwhelmed by the ISM performance, but of that manufacturing number at least. Manufacturing hasn't really picked up, but it looks like services are taking off here. What's your sort of view? You were talking to me a little bit about the role that services are playing. How do you see the construction of this going forward?
Yeah, so we've been, like you said, quite frustrated in the sense that the indicator, in terms of the manufacturing of the US economy, hasn't picked up, which we thought would, generally speaking, historically, as part of the business cycle, is a fairly good indicator of where we're heading. What I was saying to you before, in terms of the US going forward, this may or may not be the new normal, where you just see services lead and manufacturing slowly catch up towards the end of the cycle. Potentially it does make sense when you're talking about developed economies like the US, which don't have a lot of manufacturing. So once again, we're only US focused here, but the US is a driver of world growth, so it does make sense to look at the US in isolation. And same again with our 3-month indicator. We were sort of talking about that leading indicator pointing quite violently down last time we spoke, but we weren't too worried about it in terms of where we thought it was going to. It was just a basing pattern at that point, I think we said at the time. So yeah, going forward, it's that manufacturing part, something we're definitely going to keep an eye on and see if it's as useful as a tool as it's historically been.
And it's interesting, the subcomponents that we looked at that form this indicator as well, when we're talking about the new orders, which were starting to pick up, which was exciting, and the fact that inventory levels were actually falling back a bit on those indexes. So there's plenty of reason to be optimistic that these indexes are going to continue upwards. Most people seem to still be very negative on this and saying, that there's still that recession, or there are still those recessionary fears around the corner. But that's not really what the data is saying to me, I don't think.
And again, to take this out of the US again, the OECD's composite leading indicator is wrong.
Yes.
From across a number of leading economies, and on top of that, you've got a number of Fed surveys that we've just had, export and import figures, CEO confidence surveys. There's a number of things at the moment, and let's be frank, still you can draw. It's pretty flat, but it is trending up. We are, as we started today, talking about we could be still in early cycle, right? But on any level, if we're here sitting thinking, where are we? We're not late cycle. Nothing on that chart tells us we're late cycle. So I think it's actually quite consistent with what we've been saying. It's slow, but it's consistent with an economy that's recovering, and we'll start to see that kick up, I think, later this year.
And that's just given me a really interesting thought that, that could catch a lot of people off guard, right? Where they see if it is effectively ticking back just for a little bit into that early cycle, a lot of people monitoring the market will not be used to that, not expecting that. So they may interpret it completely incorrectly. Do you think that that's possibly the case?
Yeah, potentially. And with everyone's talking about, these standard valuations, which is price divided by earnings. Well, we're talking about liquidity has been driving the P in that equation, and the earnings comes with the business cycle, and the business cycle is still coming out of the low. So when we go to that end of 22, when we bottomed out, it is still in a upward trajectory. So I think it's all reasonably consistent. People are just panicking, I think, a little bit prematurely, which is not unusual at this part of the market.
And
I suppose if you're looking at it, sorry.
Oh, I was just
I was,
carry on, Joe.
I was just going to say, I suppose if you're looking at it logically in terms of the manufacturing base, it's quite a large amount of capex that would go into, like, if CEOs are quite positive on the economy, which they've actually started to do, as you pointed out, Paul. It is a slow process in terms of a capex to increase manufacturing, which is potential, and the companies have probably been a little bit less keen to do that based on where interest rates are, for example. So financing all that stuff may be a little bit more costly. So there could be a little bit of, well, we just need to wait and see, and then once we're sure, then we'll start investing in that manufacturing, that personnel to really pick up that sector.
I don't think we can discount the US either. They don't know whether they're going to have a president that's going to be tariffing everything, or the other way around. So there could be a bit of hand sitting, just waiting to see what is the way forward post 5th of November.
And we'll look at some charts in a moment that dig a little bit more into timing for some of these markets, because I think the election actually is going to be quite significant in terms of the potential pivot point for some of these things that are important to us, like whether it be the bonds or the US dollar, or just lots of things really that it seem to be exactly what you just said, Paul, sitting on their hands and just waiting to see what the outcome is, because markets do not like uncertainty. They're much more likely to move in a direction once they know an outcome. But just to wrap this section up, Paul, inflation here, we've been saying 2% for a long time. We've got that. We know that's what the target was. Both of those lines are now converging upon that 2% level. It's pretty smooth sailing, nothing to see here. Is that how you view it?
Yeah, I think so. And we should expect this to start to tick up as that market goes from early to mid. Mid is characterized by rising growth, rising inflation. So and there's a fair bit of evidence out there that the 2% is actually really 3%, and we've got to remind ourselves that when one has $1 trillion of debt, one of the only ways to get rid of that is to inflate it away. So they'd like a bit of inflation, and they don't want it to get too low for too long.
A really good point. With a little bit higher from here would still have us within what is probably the unofficial target range for sure. So speaking of debt, let's look at this. This is probably the most important part of the presentation from my perspective, because we're seeing the debt obviously continue on its merry way higher, and never thinks to come down. It just wants to go up and up and up. But what I am a little bit concerned about is this little tick up that we're seeing, and I'll just highlight it here before I zoom in a little bit closer and ask the question. But traditionally, when we've come out of these high rate cycles and we start to see the cutting cycle in place, we just see the yields really fall off a cliff here, which was sort of what happened. We started to see that, but then we've had this real tick up. And if we look at that, we zoom in a little bit and look at that over the last 5 years, this little bit at the end here is starting to be a little bit concerning to me. Who of you would like to attack that one? Because I'm a little bit worried about the potential for this to be the out of control. It's not out of control yet, but move into the out of control area where it just keeps rallying from here.
Yeah, I'll go. So we've got that 50 basis point cut at the last FOMC meeting, and the market, I think, really got ahead of itself. As you can see, there's huge divergence there between bond values and what the actual Fed fund rate is. So the markets were pricing in another 50 basis point cut for the start of next month. And I think what's happened there is that the market's got way ahead of itself. We're only factoring in a quarter of a point now based on, we had revised GDP for Q2 in the US up to 3%. So growth is still relatively strong. And the jobs numbers weren't falling apart, but sort of deviated from trend a little bit because they were starting to tick up around 4.2, 4.3% unemployment rate. And that sort of leveled out, maybe even down a touch. So in terms of doviness from the market, I think they've really repriced what the next cut's going to be. I wouldn't be surprised if that what we're looking at now is basically the end of the sell-off for bonds. It could be famous last words, but from sort of how I'm looking at it, it's just a little bit of a shakeout before everyone got ahead of themselves before.
So that could be a little bit of a peak there, and in that case, I suppose we'd still be looking at a lower high. If you're looking at this as a trend, still a lower high, and then then rolling over. Paul, can you just explain the mechanics of this? Because obviously you mentioned before we're facing multiple headwinds here for liquidity. How is this a headwind for liquidity?
Because that rising line is a rising yield, which means a falling value of the bond, and the bonds are the collateral for a lot of liquidity in the system. So, so when and you spoke about it earlier, that the collateral multiplier. So, it literally now they have a problem. So they went and changed in August the stress test rules to lower that limit, the threshold. That bought them about another $1 trillion. But you can't keep doing that with any sort of credibility. So, look, I agree with Joey. I think it has to fall because the system. This is not something that is discretionary. The system needs this liquidity, and I think they will orchestrate it somehow. We can't keep having that collateral fall like it has been.
And the other one that you talked about before, in terms of headwinds, Paul, was the US dollar, and it was that remarkably accurate. Sort of when we'd labelled the low, we just have seen 1, 2, 3, 4, 5 weeks plus of strength in the US dollar since then. I mean, Joe will probably argue, I'll ask you in a second, Joe, that this is a potential top again, but this is the same thing you were talking about, isn't it, Paul? That's the other headwind there, because
absolutely.
really that devalues everybody else's collateral.
Yeah. Everyone's got US denominated debt, and as the cost of that keeps going up, that just effectively sucks liquidity out of the system. So, so that's not helping anyone at all. And I can't see how it can stay up there. There's too much pressure for it to come down.
And Joe, is that consistent with what you were just saying? Expecting that turnover in the yields, similar here for the dollar.
Yes, there's a high correlation between the yields of US bonds and the strength in the dollar. So if you do get a sell-off, not a sell-off, the opposite of a sell-off, a lowering in yields, you generally expect the US dollar to fall, which, as we've spoken about before, is quite good for asset prices. And, once it breaks that 100, we can see we've got a number of points in the last 12, 18 months where it's bounced off the 100 mark. If once we rake through there, it's going to be game on.
And that's really interesting too, because if you look at this a little bit from a technical point of view, it certainly hasn't made a new high, at least yet, from where it had been. And even though we've had this strong rally recently, if it does top and head back down, down here, everyone was expecting it to keep going. This is your contrarian trade, right? Like that, it throws everyone off because now it's not going to keep going if everyone thinks that's the case. It just wants to hurt as many traders as possible. So now that's had that bit of a rally. If it did come back down here quite quickly, that would be the time it could break through with some conviction and really head substantially lower. Yeah,
and that could take a number of months to play out. It doesn't necessarily. That's quite definitive. The moves up and moves down, really. Like it's even though it's trading within a choppy range, it's trended quite well in terms of its tops and bottoms. So to say that that's just going to roll over and break in the 100 in the next 4 or 6 weeks, that might not necessarily happen. We might have to wait it out for quite a while.
Yeah, and I just mentioned before, you've got a number of central banks expected to cut soon. The DXY is just a relative basket, so the denominator's dropping as well, and that's still going to keep the US dollar up comparatively.
And this is just my opinion, but what do you think about this, Paul? Where are markets just sitting on their hands, like what you were saying before, for the election here? Because something as significant as the US dollar is surely going to be impacted by the outcome of the election to some degree, at least. I mean, even if it's not in real terms, because it takes a while for policies to come through, you would expect that they're very different people who are ultimately running for that position with very different policy sets. You would expect to see something happen, and I'd say the markets have been remarkably calm in the lead up to the election so far.
Oh yeah, and I do not expect that to continue over the period of the election. I think we're in for volatility because I think there is definitely that element of wait and see, and then it's a very hard one to pick because on many levels they're very similar, right? So, but then you just have these wildcards of what happens if there's just rampant tariffs and that sort of thing. It's a hard one to pick.
I mean, it probably will still be a hard one to pick after the election as well, because you don't know how much of that is rhetoric and how much of that actually follows through into actual hard policy. So now we go and look a little bit at the weekly global liquidity. We're actually a week behind on the data here, but it's reflecting something that we have been talking about, this little bit of a potential air pocket here where we were heading up very nicely, and then all of a sudden, we've had those headwinds that we've been talking about really starting to drag a little bit. Hopefully a short-term phenomenon. Really what I wanted to talk about was this chart. On the back of that, due to the move index, Paul, you explained this just before with the importance of the collateral that underlies the system, and the move index is tracking the volatility of the bonds, so the bond market. So that is directly showing the volatility of that underlying collateral. We're here at 2024 highs and certainly at elevated levels overall. I mean, is this a concern? Is it something we should be worried about? I mean, I can see it two ways. It's concerning that it's high here, but does that mean it's going to ultimately head lower? How do you look at this chart?
Well, as I said before, I think it has to. So when we turn the cycle, you can see how high it was, as you would expect in a tighter liquidity environment. But when there's stress in the system, but I think what inevitably must come over the coming quarter or two will bring that back down into the normal zone. So again, we've got the volatility over the next couple of weeks to see how that plays out. But I don't see a scenario where it doesn't drop back into that normal zone.
Joe, do you think part of the reason that Paul could be right there is if it doesn't naturally drop in, this is exactly what your job is as a government, as a central bank, as a treasury, to force that lower?
Yeah, and I think we would be naive to think that the Treasury and the Fed are not looking at how the bond market's trading, since it's the collateral that basically underpins the world's financial economy. What I was going to add to what Paul was saying is, we spoke about the TGA being spent down. Now, if the TGA needs to be spent down, I haven't actually looked at the upcoming issuance or even how much there is. I need to research it a bit more. But if you're spending down the TGA, there's no real reason to sell bonds in the market, right? So if there's no reason to sell bonds in the market, then that means that bonds need to be purchased from the market. You're not going to get on the run, as in new issuance from the Treasury. So if there's a shortage of bonds, you'd imagine that there's a bid for that collateral, which would bring the move index down. Because generally speaking, the move index rises on the back of bond sell-offs, not generally because bonds are being bought up, if that makes sense. So,
but I think you're bang on. That logically makes sense.
What was it about on the run? Sorry.
That I know you were just sort of winging that then, but it's that makes a lot of sense. Yep.
Yeah, and to be clear, on the run means fresh printed bonds from the government.
You were on the run. On
the
run. Yeah.
No. Everything Joe says is well researched, Paul. I don't know what you're talking about. So, pulling all this together, how should we be allocated Bitcoin, gold, silver? A lot has happened this month. That's how I started off at the beginning of this, saying it really has been a massive month for all of these things. But let's sort of step us through our logic of why we're specifically looking at Bitcoin, gold, and silver. We know global liquidity is tied very closely to world wealth. You can see that correlation very clearly. We've talked about it a number of times. We know that some things keep up, as in particularly gold, silver, crypto, monetary inflation hedges, things that we refer to as being able to keep pace with that inflation that occurs. And we're not just talking about the CPI inflation here, which is the one that is always reported, the low number, the couple of percent number. We're talking about asset price inflation as well, which is the cost of your house and everything else that you need as well. This is the wealth divide we've talked about many times, the difference between what asset prices are doing and what inflation is doing. And we've seen these are the assets that manage to keep up with that black line which is the global liquidity over the very long term. So that's sort of the foundation of our thinking around all of this. We know the most correlated asset is Bitcoin to global liquidity. It's still new. We accept that. We're only talking about a relatively short period of time compared to something like gold that's been around for 5,000 years that has maintained that same level. So, we've got a nice mix there. But let's dig into some of the specifics this month, because, as I said, it's been just an absolutely interesting and bumper month for all of these assets. Bitcoin, Joe, I want to start with you on this. We have already seen this bounce around quite a lot. Remember, this is using the average for the previous month. So, we've seen this come quite a bit higher, ticking up, it would seem, with the global liquidity index. And specifically, when I flip us over to this next chart, when you look at it on a log scale, it looks dead flat. Looks like it's barely moved at all. Yet liquidity is starting to do its job. Are we setting up here for the big bull run that everyone's been waiting for? What's your view? I'm getting pretty bullish.
Yeah, I think that's why, like you said, it's been flat, and that's why it's important to actually zoom out and overlay it with liquidity momentum as well. Because if you'd just been living for the last 6 months, you'd be pulling your hair out at the Bitcoin price. But when you do take that step back and you look at the massive run up that we had all throughout the end of last year and into the early this year, the way I'm looking at it is it just got ahead of itself. Like, we did have liquidity rising, but that, even though it doesn't look super aggressive on that chart, we went from 19,000 to 70,000 in the space of no time at all, right? So, we had that little air pocket in the middle of the year, and by little I mean it lasted a couple of months. And really, exactly like you said, I think I'm quite bullish, and it's really shaping up in the next couple of months. And we've said this from the very start, that towards the end of the year, in terms of seasonality and where we think liquidity is heading, the end of the year, early 2025 is going to be the time that you're going to want to be holding these assets.
I have to add too, because I'm not sure how good your mic is, Chris, but just as you wondered whether Bitcoin was about to take off, lightning struck in the background, thunder roared. The gods have spoken, and I think they're saying you're on the money.
It's most certainly a sign. I just have to just pause on this and really highlight the importance of using a logarithmic chart every so often when you're looking at these things, because it feels like, as you pointed out, a hell of a year, right? Like, it's really a frustrating year for people who are looking at Bitcoin, but it's not. There's no negative there, right? It really has held up remarkably strongly against everything that's gone on this year, and we're sitting right at the top of the range, exactly as predicted.
And how many bear market calls have we been getting for the last few months? Now they've seemed to dissipate a little bit, just because Bitcoin hasn't actually broken down. Where at time of recording, we're pushing up against 69 again. So I think everyone knows it's coming, but in terms of patience, it gets the better of people, particularly over 6 to 8 month periods. It's quite a long time.
And if we zoom in, this is the weekly global liquidity data, which is using the raw trillions of dollars number and the Bitcoin price. Now, this is 2 weeks old now because I haven't got the latest update on this data yet. But you were talking about this, Joe, saying the last time we looked at this that liquidity was moving ahead. Bitcoin was probably going to rally up to meet it. Has it sort of have both given a little bit of ground here?
Yeah, we got a bit of both, really, didn't we? We were maybe a little bit hopeful that the blue line was going to tick up a little quicker than the orange line, but at the end of the day, it doesn't matter in the long term. So yeah, we've just seen liquidity fall slightly over the last 2 to 4 weeks, and Bitcoin's held up relatively well. Like, we're still trading around that 69,000, and they might end up meeting each other somewhere in the middle before they take off in the next 3 months or so.
We've obviously looked at our daily signals. I know we don't use these obviously as any specific thing other than to manage our expectation on what the price potentially could do over that sort of 2 month period. Paul, we'd been saying that this cycle likely wouldn't break the highs, but the next one would. Seems like we're late in the cycle here. Potential to start a new 60-day cycle anywhere around this period of time. with all that lined up, does that to you say this is the potential to really test those all-time highs from the last cycle?
Yeah, well, we're already looking at a higher high for the first time in a while. Yeah, potentially, yeah.
And that was what we were really looking for. And there was a lot of controversy at the time about whether this week was constituted a low or not, for that to be a high or low. But I think it's got to be pretty compelling now that we're in an uptrend of some description, because really we are making new highs consistently and higher lows as well.
Yeah, and look, I think we have to remind ourselves we're looking at things in a much broader context, right? So we can look at these 60-day cycles and it's interesting and it's a a barometer of where we are. But we've just finished talking about this virtual air pocket, courtesy of China and the US dollar. It's not an environment you would expect it to be doing that. So I think it speaks volumes for the strength of the asset in the face of that. But whether it's this 60-day cycle or the next one, it's not overly relevant to our bigger picture. But it's certainly interesting to watch.
Yeah, and we always fall for that trap. It's you just want to something you can sort of sink your claws into, and that 60-day cycle is that, because it's nice and close. But at the end of the day, you're completely right. It actually doesn't matter in terms of how we think about it. This one's probably even worse along that line, Joe. Really zooming into to look at this is an hourly chart, really looking at the clusters of market positioning, and we've seen really the upside and the downside get wiped out over this last few weeks. Really, does that mean we're in the middle of no man's land here? What's your bias in this scenario?
Bias is always to the upside.
Yeah, that was probably a loaded question.
No, I think that over the last 6 to 8 months, a tremendous amount of leverage has been wiped out multiple times. So, for those who don't really understand what this chart's telling us, liquidity bands are basically telling us where all the traders are either long if they're on the bottom sides, and if the price touches that, they get liquidated, or if they're short on the top side, and the price hits that, they get liquidated. So, Bitcoin has a bit of a habit of liquidating people very quickly and then chopping sideways for a while before it has another go at liquidating them. But in terms of like where I think it will go next, I've got to look at our data, and our data is telling us in terms of seasonality and where we are that in the long term, in that 2 to 3 month range, in 1 to 3 month range, we're going higher. And in terms of the next week or two, I don't know. All I know is someone's going to get liquidated. That's all I can tell you from this.
Yeah, and I think to me this chart is just saying exactly what you just said. It's all been wiped out, right? Like all of that heavy liquidity is being wiped out. That actually clears the path for a move in either direction. I'm expecting a little bit of volatility over the election, so we'll see what happens there. But ultimately, it's cleared the path for it to go higher, because it really was a magnet lower when you had all of those liquidation points below that really did need to come back down and hit, which is exactly what happened. Now, Paul, really, it's just been a monster month for gold, probably even more of a monster month for silver. What's going on?
Everything. we've got the mixture of whilst we're talking about that liquidity coming off, it's the trajectory is still the same. The GLI, like the actual index, is still showing upwards.
Yes.
So gold is still that, but it's being supported with all the geopolitical goings on. So there's a lot of concerns. There's growing risks, growing concerns around that markets are overvalued, and that if depending who gets in, it could crash markets. So there's a safe haven play. Central banks are still gobbling it up. We've got the BRICS announcement and of a gold market and currency, and so there's so much going on in support of gold at the moment that it shouldn't be too much of a surprise to see it heading up that way. And let's not forget, I meant to say it earlier, that chart that you showed earlier of showing gold against monetary inflation. I heard since 2000 that the total stock of US debt has risen 8-fold, right? In 28-fold. Gold's gone up 8.25 fold. So gold is always going to be there as that monetary asset that will protect you against debasement. And that's all this extra debt is, right? There's just more debt printing more money. So we're in an environment of burgeoning debt, and gold's just doing what it does. It protects you. So we shouldn't be surprised by this. And
it feels a little bit. Oh, sorry, I was just going to say it feels a little bit different to me this time around something you mentioned, the BRICS angle on this. I'm just seeing a whole lot of momentum behind that from people's, well, the charts for one, showing that when you add up BRICS and friends and their gold holdings, we're talking some very large numbers here. And it feels like a lot of people at the retail level are starting to cotton onto that a little bit too and go, well, there's actually something here. It's not just a future, speculation of what they're going to do. They're actually doing it, and they're actually doing it now.
Yeah, it's not a bunch of gold bugs. I keep saying, don't do as they say, do as they do, right? Yeah. So they want us to keep using the pretend money, but they're buying up the real money hand over fist, and they're openly talking about gold-backed, trade and this sort of thing. So the writing's clearly on the wall, and you've got to take notice of what central banks and governments and big hedge funds and the like are doing. So it's no, I think you're right. It's always dangerous to say this time's different, but zooming back, we've been talking about this cup and handle for ages, right? So
yes,
and it's a big one, right? So it's a secular cup and handle. Well, we're clearly seeing that play out. The handle's taking off. So
yes, true. And so you could argue regardless of all those geopolitical events and BRICS and all of it, even technically, we saw this coming for quite a while. For sure. I mean, silver, it tends to follow what gold's doing there, but it's really been performing spectacularly well, as finally breaking out.
Yeah, absolutely. And that's off the back of some big international purchases and moves in that market and that sort of thing. But as we keep saying, silver comes in to the party late, and gold's been going harder for a while. Context everything. I think you've got a GSR chart there as well. So
I want to talk about this one.
So for context, yes, it's gone harder than gold of late, but whoop-de-doo, it's gone from 85 down to 80 in terms of the gold-silver ratio. If it drops down to around your average of sort of 50, that's what $90 silver, right? So in US dollar terms, so almost tripling of silver.
Now, this is a new chart, and I know there was a little bit of controversy because we were discussing, for example, you were pointing out in 2011, I think you're saying this actually got down to 30. So the numbers that make this up are the yearly close price, because it's obviously difficult to construct a chart with all the different prices throughout the year. And this was just taking the close price and then reflecting where we are currently to that. But I still think it gives us a pretty good indication that when you look historically, even over the last 10 years where gold has been particularly outperforming silver, we're above that level, above that average. We're above the 50-year average at 63 and well above the 100-year average at 56. Now, we've seen periods and could probably expect to see them again where we get this ratio right down into potentially 40, 30, 20, who knows. To me, it's moved me personally to start looking at this more, taking this more seriously, to go, it could be a generational opportunity here to load up in silver and convert that silver to a lot more gold down the track. It's not a quick trade, right? This is a 100-year chart. It's not a quick trade, but it's probably about as good as it's been in any sort of recent time to be thinking about doing that now.
And for two like-for-like assets, right? Yes, silver's half industrial, half monetary. Gold's pretty much just monetary now. When they're like-for-like, maths matters, right? So if you believe in nothing else in this world other than maths and reversion of the mean, right? And let's remember, average is just midway. So to get, to dance around that average, as you said, it's got to come down around the 30. They're quite extraordinary. Like I was talking about, tripling to get to 50, you can do that again. So we've seen a similar cup and handle with silver. It's tested everyone's patience for a long time, But reversion of the mean is real. We saw it as recently as 2011 at 30 to 1. So it comes later in a cycle, and when we're talking about a cycle that could be mid to late next year, you would start to see it move. So I'm incredibly bullish on silver at the moment, and but I know it's silver, and it will take us for a ride. It will not be smooth, but the end of the journey should be good.
And it's such a good point that it's a very challenging to be able to have a mindset that operates over this time frame, because this is the ride that everyone was taking on. The people who thought that was going to be it back after the financial crisis, and it was a long time where gold was outperforming. But at some point, silver will, and it's a question of whether you fall for that again and start buying down here somewhere, going, yeah, okay, silver's the outperforming one, that's the one I want to own, or whether you take the advantage while it's up here. And I suppose
you can't ignore the fundamentals, right? So we metals focus, who do all the research for all the big houses, have us in a deficit for 5 years of silver.
Yes.
So we've got a metal that's being used for green energy, for medical, for electronics. All of those are not cyclical, right? They are growing markets with an asset, or with a commodity that's in deficit for 5 years. So there's pressures on this that I think will play out.
I completely agree. I've been certainly more focused on this trade than I have for a long time. This chart just shows that against the GSR, probably not so relevant at this particular moment. Nothing of particular interest there, but we'll certainly be paying attention to that. But it is a slow-moving beast. So we always like to wrap this section up with our simple trading plan, and this is one that we've been following along for quite a while now. This is just to give sort of some value back to people so they can see, okay, where are some actual signals that I could trade on this based on how you guys would do it yourselves. And this is certainly something we have been doing ourselves. Pretty simple strategy. Buy low, sell high is the idea. So when we get that conviction that the global liquidity cycle low is in place, that will generate our buy signal. When we get that conviction that the high is in place, that will generate our sell signal. We've been trading this. You've seen this chart before on the daily cycles. We had that entry back in January of 2023, and we've been riding that through ever since. We haven't had a sell signal yet because we don't think we're at the end of that liquidity cycle yet. So we've got the historical performance on that being quite good over the last, now amounting to quite a lot of time, 657 days. We are nearly 300% up, which is annualized 158.6%, which is no small number and no small feat, I don't think. So it just goes to show the power of understanding these cycles and just really a buy and hold, but knowing that you're holding that for an end date and being able to sell that at that top. So hopefully that is coming up towards the end of next year, and we'll all be very happy with that particular trade. So on that note, that sort of brings us to the end of all of our formal analysis and all of our charts. We'll do what we usually do and wrap up with some final thoughts for what's ahead or things people want to reiterate. Probably for me, I'll start off. For me, I think what Joe said before about the seasonality and where we are in this cycle has me quite bullish, even beyond the potential little air pocket and headwinds that we've been facing with that global liquidity recently. I think we probably can overcome that to the upside. It just might take a little bit longer than we were expecting. We were thinking all of that towards the end of this year, which still is in play, but it might really push into the start of next year before we see that real, new highs potentially in Bitcoin. Gold and silver have already, performed spectacularly, but I think there's more to go in that. So that's probably my thought. Is it's all still looking good, but we've got potentially a little bit more drag before we see those real gains ahead. And maybe a lot of certainty comes in a few days' time when we get past this election in the US and the markets know exactly where we're heading from there. Joe, your wrap up?
Yeah, so speaking of elections, you mentioned it before, there's likelihood of a lot of volatility. But historically, over the last 4 elections, whether it's Obama, Trump, or Biden, or no matter who's won, Bitcoin's performed historically very well post the election. So I think going forward over the next week or two, if we're looking at a short time frame, you spoke about the long, so I'll talk about the short. Any volatility to the downside, I would be considering that as an opportunity to add to any positions. I'm talking specifically about Bitcoin. I'm sure Paul will talk about gold and silver, but in terms of Bitcoin, I would see that as an opportunity.
Paul?
Look, yeah, I think I said the same at the end of last time. We just got to watch China. They are the biggest headwind at the moment, and I think their options are running out. So they may be a little emboldened because the yuan actually strengthened last time they did some, and that's their biggest concern. So watch China and watch that US dollar. I think if we start to see the US dollar drop and China actually do something material that recognises that both their people and their businesses have no money, so it's the PBOC are going to have to inject, then that could be the game changer.
Well, thank you very much, Joe. Thank you very much, Paul, for your insights and work on that for this month. As always, we appreciate everyone for watching. If you have any feedback or comments that you'd like to offer, feel free to reach out. You can contact me at Tipper Analytics on X is probably the best way. As I said, thank you both. And we'll be back again next month for November to see how all of this unfolded. We will be on the other side of an election. We will have no doubt lots more insight into what's going on with that blue dot and where we are on the chart. So lots to look forward to. Thanks again, guys. And thank you everyone for watching. We'll chat again soon.
Cheers, mate.
Thanks, mate.